Welcome back to the deep dive. Our mission today, well, it's all about getting under the hood of institutional finance. We're diving into something called Smart Money Concept, SMC, which has been really popularized by the Inner Circle Trader, or ICT.
Yeah, and this is, if you're looking to move beyond just guesswork, if you really want to understand how the big players think, BlackRock, central banks, huge funds, how they actually influence price, you kind of have to adopt this way of looking at things, this
Yeah.
institutional lens.
Exactly. That's the goal today, getting away from those indicators that always seem late, and instead asking, what clues, what footprints do these massive entities leave behind on the actual price chart?
Mhm.
So the core idea really is that SMC is just a way of analyzing charts based purely on price action, but seen through their eyes. You sort of ditch the standard retail tools.
Right, because those tools, things like RSI or MANTD, they often just show you what happened after the smart money made its move. They show the effect, not the cause.
You want the cause. We want to understand why price moved.
Precisely. We're trying to align ourselves with the biggest force in the market. The aim isn't just to react when something happens, but to anticipate it. And to do that, we really have to start with the absolute bedrock concept, the engine, if you will.
Right, let's talk about the fuel, liquidity. You hear this term all the time, but what does it actually mean in this context? When these institutions place huge orders, and we're talking like billions potentially,
Yeah, tens of billions sometimes.
you can't just hit buy or sell and expect it to fill instantly like we might with a small retail order, can they?
Absolutely not. That's a fundamental misunderstanding many have. See, every single trade, every single one, needs someone on the other side, a counterparty. If a big bank wants to buy $1 billion worth of euros, somebody, somewhere, has to be willing to sell €1 billion at that exact moment, at that exact price.
Okay.
So liquidity, in simple terms, is just the ease with which you can execute large orders without drastically moving the price against yourself. It's about finding enough opposite orders to fill your own massive position.
And because their orders are so big, they can't just passively wait for sellers or buyers to appear. They have to actively go looking for them.
Exactly. They have to hunt it down. They need to figure out where those pools of opposing orders are concentrated. And this right here is where the typical retail trader often gets caught out.
How so? Where is this liquidity usually found?
Well, the bulk of it, the really concentrated pools they need, tends to sit just behind obvious chart points, specifically swing highs and swing lows.
Wait, so where people put their stop losses?
Precisely. Think about it. If you go long, you buy, where do you typically place your stop loss for protection?
Usually just below a recent low, a swing low.
Right. And what is a stop loss, fundamentally? It's a pre-placed order to sell if price hits that level. So for the institution looking to buy massive size, that cluster of sell-stop orders below the swing low is exactly the liquidity they need. It's a guaranteed pool of sell orders waiting to be triggered.
Wow, okay. So the market isn't just randomly bouncing around. It's actually moving almost intentionally from one of these stop-loss zones to another.
Yeah.
It's like our risk management becomes their roadmap.
That's a great way to put it. It's an operational roadmap. Smart money will often engineer price action, creating patterns that look attractive to retail traders. Clean trend lines, obvious double tops or bottoms. They do this to encourage people to take positions and place their stops in predictable locations.
To induce participation, as the term goes?
Exactly. They need those stops clustered together. So they create the setup, let people jump in, then they run the price to sweep that liquidity to trigger all those stops, absorb those orders, and then they launch the real move in the direction they intended all along.
So they're not stop hunting in a malicious way necessarily, but fulfilling their own order requirements using those levels.
Correct. It's a mechanical process. They need contracts. The stops provide those contracts. It's business.
That really clarifies the idea of a sweep. How do we actually spot these zones, these liquidity pools, on a chart? Is there specific terminology?
Yes, very specific. We talk about buy-side liquidity, or BSL. This refers to all the orders mostly sell stops from short positions that are resting above a previous high or series of highs. If price is moving up towards BSL, the institutions are targeting those who bet on the price going down.
Okay, BSL above highs. Makes sense. And the opposite.
That's sell-side liquidity, or SSL. These are the orders resting below previous lows, mostly buy stops from long positions. When the market drives down toward SSL, it's aiming to take out the buyers.
BSL above, SSL below. Got it. Are there times when these zones become particularly obvious or attractive?
Definitely. Look out for equal highs, EQH, or equal lows, EQL. This is when price touches a certain level multiple times, creating a really clean, flat top or bottom. Think of a textbook double top or a perfect horizontal support line that's been hit 3 or 4 times.
Right, the kind of thing traditional technical analysis might see as strong resistance or support.
Exactly. But from an institutional perspective, those clean levels are just screaming massive cluster of stop orders here. They become magnetic targets because the liquidity is virtually guaranteed.
Okay, so they target these zones. What does the actual sweep look like on the chart? How do we know they've just taken liquidity and aren't actually breaking out?
This is key. A genuine liquidity sweep. The act of absorption is often very quick and aggressive, but it doesn't usually sustain. You'll see price push decisively through the high or low. But then look at the candles close.
Okay.
Often, only the wick of the candle will penetrate the level. The main part, the candle body, closes back within the previous range. That wick represents the raid they grabbed the orders. The body closing back inside signals they absorbed what they needed and instantly reversed the price delivery.
Ah, so a wick breaking the level, body closing back inside. That's the visual cue for a sweep.
It's a very strong cue, yes. It suggests absorption, not continuation. Now, if the candle body closes strongly beyond the high or low, that's usually a different story. That often signals a genuine break of structure, which leads us nicely into our next topic.
Okay, so liquidity is the fuel, driving price from zone to zone. But if we don't know the overall direction, the intended destination, we're still lost, right? This is where market structure, MS, comes in. You said earlier this is maybe the single most important piece.
I'd argue it is, yeah. Because market structure gives you the context, the narrative. It tells you which way the larger flow is likely headed. Without understanding the structure, you won't know whether institutions are currently hunting buy-side or sell-side liquidity. You won't know the bias.
So how do we track it? What are the absolute basics?
It all boils down to tracking the sequence of highs and lows that price creates as it moves. Simple as that.
Okay, highs and lows. We need to define those clearly, though, right? What constitutes a proper swing high or swing low in this framework?
Yeah, we need a clear definition to avoid ambiguity. We usually look for a specific pattern, typically involving 3 candles. A swing high looks like a little hat or an A shape. The middle candle makes the highest point, and critically, the candles immediately to its left and right must have lower highs.
Lower highs on either side of the peak candle. Got it. And a swing low.
The opposite. It forms a V shape. The middle candle makes the lowest point, and the candles immediately flanking it must have higher lows. These swing points are crucial because they mark the points from which the market starts its next aggressive move, its next expansion.
Okay, so we identify these swing points. How do they tell us the trend?
In a clear uptrend, you'll see a pattern of higher highs and higher lows. Price makes a high, pulls back to a low, then pushes up to make a new higher high, then pulls back to a higher low than the previous one, and so on.
Higher highs and higher lows.
Yeah.
And when price successfully breaks above a previous swing high in that uptrend.
That's the confirmation signal we're looking for. That's called a break of structure, or BOS. When the price not only trades above the previous high, but usually closes with its candle body above that high.
The body close is important again.
It often is, yeah. It signifies conviction. A BOS is basically smart money signaling, okay, the uptrend is continuing, our bullish bias remains. A clean, strong BOS gives you a high probability expectation for where price is likely headed next. It confirms the directional bias.
Okay, BOS confirms continuation, but trends don't last forever. What happens when the pattern breaks down? How do we spot a potential reversal?
This is where it gets interesting. If the market starts violating the established pattern of the trend, that's a potential warning sign. We call this a change of character, CHOCH, or sometimes a market structure shift, MSS. It suggests the underlying dynamics might be changing.
So in our uptrend example, what would a CHOCH look like?
Instead of making a new higher high and then a higher low, imagine price fails to break the last high. Then it turns around and aggressively breaks below the most recent significant swing low that was formed. That violation of the low is the CHOCH.
Okay, breaking the low in an uptrend. But you said significant swing low. How do we know which low matters? Because price makes lots of little lows on the way up.
Excellent point. This is absolutely critical. We need to identify the protected low. In a strong uptrend, the specific swing low that was responsible for initiating the move that created the most recent highest high is considered the protected low.
Ah, the low that caused the highest high.
Exactly. That low point is significant because it likely holds the concentration of institutional buy orders that fueled that last push higher. If the institutions allow price to break decisively below that specific low, it's a very strong signal that they're potentially done with the uptrend. The bias may have shifted.
So breaking a minor pullback low isn't a CHOCH, but breaking the low that created the last high is.
That's the general idea, yes. Breaking the protected low signals a potential major shift in institutional positioning. Breaking a minor intermediate low might just be a deeper pullback or retracement within the existing trend. Context is everything.
That distinction seems vital for not getting faked out on reversals. And you mentioned something earlier about these concepts applying everywhere.
Yes, absolutely critical to remember. All these SMC concepts, liquidity pools, swing points, BOS, CHOCH, they are fractal, meaning they work and appear on all time frames. You can spot a clear uptrend with a BOS on the daily chart, confirming your long-term bullish bias. Then you can zoom right down to the 15-minute or even a 5-minute chart and look for the exact same patterns, a smaller swing low forming, followed by a BOS on that lower time frame to pinpoint a precise entry point that aligns with the larger daily trend. It's patterns within patterns, all reflecting the same underlying institutional logic.
Okay, this is making sense. We know why price moves to grab liquidity, and we have a map market structure telling us the likely direction. Now, we need to figure out where is the best place to actually get involved. You mentioned smart money buys low and sells high. How do they quantify low and high?
Right, this isn't just a vague idea. It's about precise risk management. For institutions dealing with huge size, getting a good price isn't optional. It's essential for their profitability. They simply cannot afford to chase price and buy the top of a move or sell the bottom. They need optimal pricing.
So how do we define these optimal zones? Is there a tool?
Yes, we use a very common tool, but perhaps in a slightly different way, the Fibonacci retracement tool. We use it to measure a specific price leg, typically the distance from a significant swing low up to a significant swing high in an uptrend, or vice versa in a downtrend. This defines our current operating range, the expansion leg.
Okay, measure the range from low to high. Then what?
The Fibonacci tool automatically marks the 50% level of that range. This 50% mark is crucial. We call it the equilibrium price. Think of it as the fair value for that specific range.
Equilibrium, the halfway point, fair value. Got it.
Now, everything above that 50% equilibrium level is considered the premium zone. Prices here are relatively expensive, potentially overpriced compared to the recent move. If your market structure analysis tells you the overall bias is bearish, you're looking to sell, you should only be looking for sell entries within this premium zone.
Sell high in the premium zone. Makes sense. And below the 50%?
Everything below the 50% equilibrium level is the discount zone. Prices here are cheaper, maybe on sale relative to the recent highs. If your market structural bias is bullish, you're looking to buy, you ideally want to wait for price to pull back into this discount zone before considering an entry.
Buy low in the discount zone. So this isn't just a guideline, it's more like a rule for disciplined trading.
I'd call it an obligation, really. If you're trying to trade like an institution, you have an obligation to seek entries in the correct zone. Discount for buys, premium for sells. Why? Because it automatically stacks the potential risk-reward ratio in your favor before you even find the specific entry trigger. Buying deep in discount gives you much more room for profit potential compared to buying near the highs.
That makes perfect sense from a risk management perspective. Are there even better spots within these zones?
Yes. While any price in the discount zone is technically good for buying, institutions often favor even deeper pullbacks. We look for reactions around the deeper Fibonacci levels within the discount zone, specifically the 62%, the 70.5%, and sometimes even the 79% retracement levels.
Deeper discounts.
Exactly. These levels collectively are often referred to as the optimal trade entry OTE zone. When price retraces that deep into the discount or up into premium for sells and finds support or resistance, it's a strong indication that institutions are aggressively re-engaging at a price they find highly favorable.
OTE, optimal trade entry. Deep in the discount or premium.
Okay.
And this links to the term PD array.
Precisely. PD array is just shorthand. The PD stands for premium discount. It tells you the location you must be in the correct zone. The array refers to the specific arrangement of institutional reference points or footprints that we look for within that premium or discount zone.
Ah, okay. So find the structure, bias, identify the range, mark the premium discount zones, wait for price to enter the correct zone.
And then you start looking for one of the specific PD array patterns within that zone to signal the potential entry. After a strong move, like a BOS, confirms the trend, you expect a pullback. That pullback ideally comes back into discount for a buy or premium for a sell to allow institutions to recharge or add to their positions at a good price. The next logical step is identifying what those recharge points look like.
All right, this feels like we're getting to the actionable part. We know the direction. We know the optimal price zone, premium discount. Now, what are these specific footprints, these PD arrays, that signal smart money was likely active here and might provide an entry? Where do we start?
The absolute foundation, the one most people learn first, is the order block, OB. This represents a specific point where significant institutional orders were likely injected into the market.
Okay, order block. What's the precise definition? How do we spot it?
An order block is defined as the last candle of the opposite color, right before a strong, impulsive move, what we call displacement, that result in a break of structure, BOS.
Last opposite colored candle before a strong move that breaks structure. Can you give an example?
Sure. For a bullish order block, you're looking for the last bearish candle, a down-close candle, right before a powerful surge upwards that breaks a previous high, BOS. That last down candle is your bullish OB.
Okay. And for selling?
For a bearish order block, it's the reverse. The last bullish candle, an up-close candle, just before a sharp drop downwards that breaks a previous low, BOS. That last up candle is the bearish OB.
Why is that last opposing candle so significant?
Because theoretically, that's the precise point where institutions had to absorb all the opposing orders and inject enough of their own volume to completely reverse the short-term momentum and initiate the strong move, the displacement. It marks a critical point of institutional intervention.
So when price comes back to that level,
They often defend it. If price retraces back into that order block zone after the BOS, it frequently acts as strong support for a bullish OB or resistance for a bearish OB, offering a potential entry point. A quick tip here. Sometimes on lower time frames like the 15-minute, an OB might look like a messy cluster of small candles.
yeah, indecisive.
Right. If you see that, try zooming up to a higher time frame like the 1 hour or 4 hour. Often that entire messy cluster will resolve into one single clean order block candle on the higher time frame. It just makes defining your zone much cleaner and more reliable.
Good tip. Okay, that's order blocks. What about these other ones you mentioned associated with reversals? Breaker blocks, BB, and mitigation blocks, MB. They sound different.
They are, and they often occur around a change of character, CHOCH, or market structure shift. They signal a failure of a previous expectation. Let's start with the mitigation block, MB.
Okay.
Imagine price is in an uptrend, trying to make a new high, but it fails to take out the previous high. We call this a failure swing. The upward momentum stalls. Then price reverses aggressively and breaks the last protected low, giving us a CHOCH.
So the attempt to continue the trend failed and structure shifted bearish. Where's the mitigation block?
The mitigation block is often found back up at the origin of that move that failed to break the high. Price will sometimes rally back up to that specific point, the level where bullish orders were injected but then got trapped when the high wasn't broken. Institutions revisit this level to mitigate or offset those losing buy positions before allowing the price to continue lower in the new bearish direction. It's like they're cleaning up their books.
Okay, mitigating trapped orders from a failed move. What about the breaker block, BB?
A breaker block is conceptually simpler. It's basically a failed order block that flips its role. Imagine you identified a clear bullish order block that you expect to act as support. But instead, price slices right through it aggressively, breaking it completely.
So the expected support fails.
Exactly. That level is now compromised. When price later retraces back up to that now broken bullish order block, it often acts as strong resistance instead of support. The OB's role has been broken, and it now serves the new opposing trend. Same logic applies in reverse for a bearish OB failing and becoming support. Breakers are powerful because they show a clear, violent rejection of a previously significant level, strongly confirming the CHOCH.
That makes sense. Failed support becomes resistance. Failed resistance becomes support. Very clear. Now, what about the fair value gap, FVG, also called an imbalance? This one sounds quite visual.
It is probably the most visually obvious PD array. An FVG is essentially a gap or an inefficiency left in the price chart during a very strong one-sided move. You identify it using a 3-candle sequence.
3 candles? How?
Look at 3 consecutive candles moving strongly in one direction, upwards. An FVG exists if the high of the first candle's wick does not overlap with the low of the third candle's wick. There's a literal gap between wick 1 and wick 3.
A visible gap between the first and third candles reach. Why does that happen?
It signals extreme order flow imbalance, massive displacement. In an upward FVG, it means buying pressure was so intense and rapid that there were effectively no sellers offered within that price range, leaving a void. Institutions, especially algorithms, needed to push price quickly to fill large orders, and this imbalance is the result.
And why is that gap important after it's formed?
Because the market tends to dislike these inefficiencies. Price often wants to return to that FVG zone later to reprice that area, to allow trading to occur where it was previously skipped over. It needs to re-equilibrate or rebalance the pricing before potentially continuing the original expansion.
So it acts like a magnet for price to revisit.
Very often, yes.
Yeah.
Especially FVGs that are created right after a clean break of structure. Those tend to be high probability zones where price might retrace to before continuing the trend. It's not just random, it's often seen as institutions needing to refine their entry price within that zone of imbalance.
Okay, so the return to the FEG is almost like an administrative tidy-up before the next move.
That's a good way to think about it. And just like order blocks can fail and become breakers, FVGs can fail too. We call that an inverted FVG, IFVG.
How does that work?
If price comes back to an FVG that you expected to act as, say, support, but instead it slices right through it and closes decisively below the entire FVG zone, that FEG has failed. Now, if price later rallies back up into that same FEG zone, it will very often act as resistance instead. The gap's role has inverted.
Okay, we've covered a lot of ground. We have the fuel, liquidity, the map structure, the optimal location, premium discount, and the specific landmarks, PD arrays like OBs, FEGs. Is there a final layer to this, maybe about when these things are likely to happen or how to get extra confirmation?
Yes, absolutely. We need to consider timing and confluence. A key concept for timing, especially on an intraday basis, is the power of three, E3, often described as accumulation, manipulation, distribution, AMD.
AMD, accumulation, manipulation, distribution. Sounds like a process.
It is. It describes a typical cyclical pattern of institutional price delivery, often linked to the major global trading sessions. First comes accumulation. This is usually a period of consolidation, range-bound trading, often seen during the lower volatility Asian session. Institutions are quietly building their positions here.
Okay, building positions in a range, then manipulation.
Manipulation is the trap. As volatility picks up, typically around the London session open, price will make an aggressive move to run the stops either above the high or below the low of the Asian accumulation range. This is the liquidity grab we talked about earlier.
Sweeping the highs or lows of the Asian range.
Got it.
And distribution.
Distribution is the real move. After grabbing liquidity via manipulation, price then moves strongly and trends in the institution's true intended direction. This expansion phase often kicks into high gear during the New York session. Accumulate, manipulate, then distribute.
That's a fascinating daily template. Does this AMD sequence only apply to sessions, or can we see it on smaller scales too?
Oh, absolutely. It's fractal, like everything else. We often use candle range theory, CRT, to see this pattern, even within 1, 2, or 3 candles.
How does that work on a single candle, say a daily candle?
Think about a typical daily candle with wicks. The open price represents the start, potentially part of an accumulation. If the candle first pushes up to form a high, the upper wick, that move could be the manipulation, a turtle soup fake out or liquidity grab. Then, the price sells off aggressively and closes near the low that sell off and close is the distribution phase, open manipulation distribution close.
Wow, you can see the whole AMD story in one candle's range. What about the 3-candle model you mentioned? That sounds useful for entries.
Yeah, the 3-candle CRT model is very practical for timing entries. The idea is candle 1 establishes a short-term range or consolidation. Candle 2 performs the manipulation. It will typically sweep the high or low of candle 1, often just with its wick.
The turtle soup again.
Exactly. Candle 2 grabs the liquidity. Now, the high probability move often comes with candle 3. If the bias is bullish, candle 2 swept a low, you'd look for candle 3 to trade higher aggressively. A common entry tactic is to try and buy just below the opening price of candle 3, anticipating that distribution leg upwards.
Get in right after the manipulation is done, aligned with the expected expansion from candle 3.
Precisely. And the reverse for a bearish setup. Candle 2 sweeps a high, you look to sell just above the open of candle 3, anticipating the downward distribution. It aims to capture the immediate institutional follow-through.
That provides excellent timing context. But what if things still look uncertain? Is there a way to get stronger confirmation, maybe by comparing related markets? This brings us to Smart Money Tools divergence. SMT, right?
Yes, SMT divergence. This is considered by many ICT traders as the king of reversals. It's an incredibly powerful confirmation tool because it directly compares the price action of two highly correlated assets to see if smart money is kipping its hand.
Correlated assets? Like
Yeah,
what?
the classic example is comparing forex pairs that should move together,
Yeah.
like USD and GBP USD. Or, very commonly, comparing a USD pair like USD against the DXY, the US dollar index. Normally, USD and DXY should move inversely. If one goes up, the other should go down.
Okay, so we watched two correlated or inversely correlated charts. How does the divergence show up?
Let's use the USD versus DXY example. Imagine USD Arius is approaching a key swing low, an SSL zone we identify. At the same time, the DSY, which should move opposite, is approaching a key swing high, a BSL zone. Now, watch closely what happens right at those key levels.
Okay.
If USD makes a lower low, decisively taking out its previous swing low, sweeping the SSL, but at the exact same time, the DSY fails to make a higher high, maybe makes a lower high instead, that's SMT divergence.
Ah, one makes a new extreme, the other fails to make its corresponding extreme.
Exactly. One asset sweeps liquidity, the other fails to.
What does that failure tell us?
It's incredibly revealing. The asset that failed to make the new extreme, DXY, in our example, failing to make a new high, is showing underlying strength. Institutions are defending that level, preventing it from breaking higher. Conversely, the asset that did make the new extreme, USD making a new low, is showing weakness. But the fact that DXY failed confirms that the downward push on USD is likely the manipulation, the liquidity grab, and a reversal is highly probable.
So the divergence confirms the sweep on one asset was likely the fake out.
Yes, and it does something else crucial. It helps you choose the stronger asset to buy or the weaker asset to sell. In our example, since DXY showed relative strength by failing to make a new high, it suggests the USD is strong. Therefore, if you were looking to buy based on this reversal signal, you'd likely have a higher probability trade buying the DXY or selling USD, rather than trying to catch a falling knife on the asset that actually made the new low. SMT helps pick the best horse in the race for the reversal. #tag conclusion.
Wow, okay. This has been incredibly insightful. We've really unpacked a lot of the core logic behind SMC and ICT. Let's just quickly recap the main building blocks. We started with liquidity.
Yeah, the absolute fewer, understanding that the market moves to seek out orders, specifically the stop losses clustered above highs, BSL, and below lows, SSL.
Then we layered on market structure as our map, learning to track trends with breaks of structure, BOS, and spot potential reversals with the change of character, CHOCH, paying close attention to those crucial protected highs and lows.
Structure gives us our directional bias.
Then came the pricing logic, premium and discount zones, using the 50% equilibrium level, the discipline of buying only in discount and selling only in premium.
Aiming for those optimal trade entry OTE levels for the best risk-reward, location, location, location.
And finally, we identified the specific institutional footprints within those zones, the PD arrays, things like order blocks, OB, the failed versions like breaker blocks, BB, and mitigation blocks, MB, and those very visible fair value gaps, FVG, or imbalances.
Those are the specific points of interest we look for within the right location, premium discount, and aligned with the right direction, market structure.
Before tying it together with timing concepts like AMD, accumulation, manipulation, distribution, often seen through candle range theory, and getting that powerful confirmation using SMT divergence between correlated assets.
Exactly. It's about layering these concepts together.
It really shifts the perspective, doesn't it? Moving away from just reacting to indicators and starting to actually anticipate moves by decoding the likely actions of the major players. You start seeing the chart not as random squiggles, but as a story of institutional maneuvering.
That's the goal, to read the tape, read the price action through their lens, to trade with the flow of smart money, not against it.
So, to leave our listeners with something to chew on, a final provocative thought.
Well, we've emphasized how market structure is fractal, right? And how most of these high-probability PD arrays get their validity from being associated with a clear break of structure. So the real edge, the way to significantly stack probabilities in your favor, comes from multi-timeframe alignment.
Meaning?
Don't just look for an M15 order block in isolation. First, go to the daily chart or the 4-hour chart. Establish your clear directional bias there. Are you seeing a strong uptrend with clear BOS confirming bullishness? Only then should you drop down to your lower time frame, like the M15 or M5, and start hunting for a bullish PD array, like an OB or FEG in the discount zone, that aligns with that higher time frame bullish bias.
Confirm the big picture first, then find the precise entry on the small picture.
Precisely. Aligning your entry trigger on the lower time frame with the confirmed institutional flow on the higher time frame, That's how you position yourself to catch those significant high-probability moves. That's the essence of syncing up with the real power in the market.
Powerful stuff. A lot to think about and hopefully apply. That's all we have time for on this deep dive. Thanks for joining us, and we hope this fundamentally enhances how you look at the charts. Until next time.